I would love to be able to keep giving you more information so you can improve the quality of your life by keeping and growing your money. So today we're going to talk about the Augusta Rule. So what is the Augusta Rule? That's a good question. Give me a second. Let me turn this off. What is the Augusta Rule? So the Augusta Rule is something that is unique because it's talked about a lot, right? Augusta, Georgia. Augusta, Georgia, right? Augusta, Georgia is, which camera am I going? Okay, cool. Augusta, Georgia is a city where usually the Masters is held. I think, I'm not a golfer, but the Masters, which is where golf, like the mecca of golf, happens every single year. And in the 1970s, Congress passed a law to help Augusta, Georgia, for the people that live there. Actually, let's step back. Okay, well, let me stop. I feel like I'm confusing myself too. Look, there was a rule or a law, a tax code passed in the 1970s called the Augusta Rule, which is section code 280A. And that was passed really because the city of Augusta is home to one of the biggest golf tournaments in the country. And thousands of people would flood this city to come to the national tournament. And the people who lived in the city were like, hell with that, we're out. And so they would leave and they would rent their homes to the people who were going to attend this thing. Now, as you can imagine, people who play golf in most cases and people who live in Augusta are pretty much wealthy. And you imagine that most of those wealthy people have wealthy friends, and some of those wealthy friends are people of Congress. So Congress obviously is the governing body of our country that typically writes the IRS codes, right? So they write the laws, the IRS enforces those laws. So they influence Congress at some point to say, hey, we're renting out our houses. You think we could get some tax breaks for the money we receive? So Congress says, yeah, I think we could do that. So they passed the rule 280A, which is known today as the Augusta Rule. Now, why is this important to know? Because the Augusta Rule, and by the way, it looks like my head gets cut off there a little bit, or no, maybe not. Okay. So the Augusta Rule really states that you could rent your personal residence, your vacation home, or a secondary home 14 days a year to your business. Now, there are some things that you need to know before we go that far, but just know that what we're trying to do is we're trying to get our company, our business, to rent out our home for 14 days. Now, before we can get to that point, we need to know what kind of business we must have. So to do this, you've got to have either an S Corp, C Corp, or a partnership. Now, why is this important? Because some people are trying to do this without one of these. So they're trying to do a sole proprietorship. Does not work. So if you're a single member LLC who files on your personal tax return on Schedule C, doesn't work. You have to be an S Corp, C Corp, or partnership. That's the criteria. Then you have to have a primary residence, right? So it's either your primary residence that you own, by the way. You can't rent it. Primary residence, secondary residence. And the key word is residence. If you rent it out, it can't be done. Or vacation home. Right? You have all these three. The total you can do is 14 days, but you have to use one of these vehicles. Now, you can't rent the property and use the Augusta Rule, so you have to own it. So you have to be an S Corp, C Corp partnership. You must own a primary residence, secondary residence, or a vacation home. You can use it up to 14 days. Now, how does this benefit you? Okay, so if you can rent it up to 14 days, you have to use the property for business purposes. So typically, if I had to put some criteria, I would say for company meetings, retreats. By the way, I do twice a year, we bring everybody to my house for a little company party. So we do meetings, retreats. Maybe if you're a social media influencer, maybe it's recording videos. Maybe it's for vendors or partners or customers. Partners, meetings, that's it. Okay. Now you're probably, what do you mean by all this? So you've got to have a reason to have people over. It's just that you don't write just a check or any of that. You actually have to have a meeting. And the meeting is going to be, okay, we're going to have our annual meeting, or we're going to have our annual retreat, or we're going to record content, or I'm going to invite some of my customers over today so we can have a get together. I'm going to have a customer appreciation party. I'm going to do something, okay? Now, my rule of thumb, number one, is you're going to at least have to do it for 4 hours. Number two, you have to document that, right? You have to document it. You can't just say you had it. So typically you want to have an agenda. And in addition to that, you want to have a list of attendees. Now, why is that? Again, we're trying to produce evidence, right? It's not what you know, it's what you can prove. So we have at least an agenda, list of attendees, right? Just document it, typically 4 hours in nature. Now, to recap here so far, I have to have an S Corp, C Corp partnership. It's got to be a primary, secondary, or vacation home. I can do it up to 14 days to have meetings, retreats, video recordings, social media stuff, vendors or partners. Typically has to be 4 or more hours, documented through either some agendas and a list of attendees. Cool. Now, how do I calculate how much I rent my house out for? So what I like to do is I like to do some research. Now, what I would want to do is I'd want to call local meeting rooms, like at the local Hilton or the local Marriott or an event space, and I would try to get the price of a daily rental for that particular venue. So typically that's going to be, in my research over the course of many years, it's usually $500 to $2,000, okay? Because you have to have what they call fair rental value. So between $500 to $2,000 per day. So in this case, let's say we did $2,000 a day at 14 days. This would be $28,000 if I did the 14 days, right? $28,000. Or if I did 500 times 14, right? It'd be $7,000. So I have to determine which one that is, right? So it's between $7,000 and $28,000 is where I would probably be at. So then I could take $28,000 as a deduction on my tax return. Now, what do I do when I make this decision? I'm going to do this. So let's say I have an S Corp. I have my primary residence. I'm going to rent it for 14 days. I'm going to have meetings, retreats, and things at my house. I did it more than 4 hours, and I documented it and had attendees. I'm going to pay myself $28,000 for that because the meeting rooms in my area are $2,000. So I get a $28,000 deduction. So in my accounting on my S Corp, I'm going to put a deduction for $28,000 for rental fees. That's how I do it. I get rental fees. So I get a $28,000 deduction. Now, at the end of the year, I'm going to get a 1099. I'm going to get a 1099 from my company equaling $28,000. So I actually am going to report this on income on my 1040. I'm going to put it under Schedule E, rental income, and I'm going to put $28,000. Now, under other expenses, I'm going to put a negative $28,000, and I'm going to cite section code 280A. And what it does is it turns it into zero now. And I have not paid anything on that income. So the $28,000, by the way, if I'm at the highest tax bracket, and I have $28,000, if I multiply that times 37%, I'm going to save $10,300 in savings. So this $28,000 equals $10,360 in actual tax dollar savings. So this is the savings because I did this. Okay? I get savings because I paid myself $28,000. Now, if you have questions on this stuff, please put it in the chat. Team, do we have questions? Now, Augusta rule, founded in Augusta, Georgia, have to have S Corp, C Corp, or partnership, must use your primary, secondary vacation home, 14 days to have meetings, retreats, videos, things of partnership, 4 hours in nature, typically the meeting documented with an agenda and then a list of attendees, typically $500 to $2,000 a day, $7,000 to $28,000 total year value. You 1099 yourself for the amount that you paid. You put it as your deduction in your Schedule C, in your S Corp. You 1099 yourself, then you take a deduction equal to that, and then you have zero taxes. Do we have questions?
Someone from Facebook said, how long would I have to keep this information from Marlon Perez? Like documented?
Yeah, typically anytime you do anything, any tax return, it's 3 years. 3 years. Most tax return information you must keep on record for 3 years. Good question. This is a lot of fun. So, man, I actually covered this all in 10 minutes, man. Some people thought I was going to take all day. If you didn't get it, I'm sorry, but I think I got it. All right, so knowing that we have this that was dumb. Let me see. I don't like to see that. Okay, so there you go. Knowing that we know exactly what Augusta means now and how it benefits us, what is important to understand is this is a loophole right now that you could use and benefit from. And for anybody who's out there, if you want to put a tax strategy in place, here's what I would do, right? I would get my S Corp. I'm just going to recap. I would get my S Corp to rent my house, right? So it rents my house. So I'm going to put rent my house, right? And I'm going to get it to rent it for $2,000 a day times 14 days, right? That equals $28,000 in my scenario, right? Now in my S Corp, in my bookkeeping, I'm going to put under rental expense, I'm going to put $28,000, $28K. So over here I got $28K and I put rental expense $28K. So this is the deduction. Over here, I've rented this. The deduction comes down to me, personally. Right? So I got me personally, I'm real happy because I got $28K in dollars. I got $28K over here. Comes direct to me. Boom. I get the $28K, I take that to my 1040. My 1040 is my personal tax return. I'm going to put it on Schedule E, and I'm going to put Schedule E equals 20. Now what I'm going to do is I'm going to subtract 28K because I'm going to put that I'm using it for code section 280A, and it's going to show zero income on my tax return. So very simply put, and I never drawn that. Okay, cool. Any questions?
Yes, I have a question. How does the depreciation help limited partners? What about depreciation recapture? Dr. Curie?
Ooh, okay. Well, that's a little different from what I'm teaching here, but I like it. All right. Do we have any Augusta before I go on to the next? We'll go into that. Good. All right. So I got to ask the question right now. How does depreciation help limited partners? Well, I can answer that just generally. Depreciation helps limited partners by giving them a deduction called depreciation that would exceed any gain that they may have. Hopefully it may exceed. So for an example, if you receive cash flow from a property, then your depreciation expense may offset that so that the cash flow that came from the property puts you at zero. So you get tax-free cash flow. Having that said, limited partners do not benefit from losses offsetting other income like most people want. They can only benefit from offsetting other rental income. So if you had other rental income, let's call it from another property that showed profit, the losses from your limited partnership could offset that income. So that's how they work when you have limited partners versus what we would call active, rather than active investors versus limited investors. Good question. Do we have other questions from the week that we could go through? Look, I thought I was frozen. I think we had some questions, right?
Can you pay each partner to rent their house?
Can each partner do this? Actually, it's a good question. Actually, it's 14 days total. Because it would be if you had 20 partners in there, you would do it. No, it's only per business. Good question. Good question. 14 days total.
I think you already answered this one, but it says, how long would a meeting at your home have to be qualified? An hour or two?
4 hours. 4 hours, right here. 4 hours. And you must document it by having an agenda and a list of attendees. Good question. All right, while we're waiting for some more questions, a lot of the times when I think about this strategy, it's the most common, by the way, this is a very common strategy talked about. However, very few people know how to document this right. Very few people do this right. So they just do the payment, but they don't do the 1099. Then they don't go to Schedule E. And so it causes a lot of confusion for your bookkeeper, causes a lot of confusion for your tax preparers. it's very messy when you don't do this correctly. So you have to be very careful on what you're doing. You've got to document how you came up with this 500 and 2,000, by the way. So that means you've got to at least put the reason I called the Hilton, I called the Marriott, I called everywhere, and that's how much it costs. That's why I'm saying it's so important. Any other questions? So we're going to actually change up the format next week, everyone. And the format's going to be your questions that you ask to me through either Messenger or comments. We're going to take those questions and we're going to move them into our live answering Q&A here at 12 Central Standard Time every Wednesday. So I'd love to get more of your questions answered. So as you got questions, put them in the chats, put them in on the comments, put things together so we can actually engage with those questions, and I'll tag you on them so that we don't miss anything. My goal is to answer the questions, but make sure that we give you the best information possible, and we do it within a timely manner, because the truth is I got very limited time and I want to answer all of them, but I can't all the time. So why don't we do it at this type of format? So I hope this helps you. And
You got a question?
Go ahead.
Do you need to justify the cost per day even if the group is 2 people, the 2 W-2?
No, because it's just because if you're doing 2 people to claim the Augusta rule, it wouldn't matter, because just like if you went to a meeting space at a hotel, and let's say it's $2,000 a day, they're not going to say, well, how many people are you going to bring in? They're going to say it's this price and that's it. So it doesn't matter how many people are going to be there. Remember, you have to own the home, though. Very important.
And sir, we actually did gather questions from other platforms like you wanted. I'm not sure if you want to answer those.
Let's answer 1 or 2 there. Let's do that.
We have a question from Instagram. Cost segregation doesn't write off W-2 active income as cost segregation, asset income activity.
So a cost segregation study, well, first off, what you're asking is, can depreciation offset income from a W-2? The answer is, in short, is yes and no. The reason I have to say yes and no is because when you use cost segregation as a strategy, that means you're going to use accelerated depreciation through the form of cost segregation. For those of you who don't know what that is, cost segregation is a study performed on an asset like real estate that would use that asset or would break that asset into smaller pieces, which then could accelerate its depreciation schedule. Typically, 27 and a half years is what you would get for a home. With accelerated depreciation using a cost segregation study, you would accelerate it typically in less than 10 years, 10 to 15 years. So it cuts it in half. It's a good way to think about it. Now, to offset income, the only way you could do that is by either designating yourself as a real estate professional by meeting requirements of 750 hours and more than half of your time. A lot more goes into that, but you have to be a rep. Or using a short-term rental strategy, which means you could use a short-term rental to meet the loophole, which means spending 100 hours managing your own short-term rental throughout a year. Typically, and most of the time it has to be rented for 7 days or less. That defines it as a short-term rental. Or you could use a self-rental strategy, which is where you rent your own company, your own building that you own. That is another way to do it. But again, you'd have to meet the criteria, which is real estate professional status, short-term rental loophole, or the self-rental in order for you to be able to offset income using a depreciation schedule to offset W-2 income. Good question.
You have another question by Nicholas. Can you take the Augusta rule personal and use the office use deduction for reimbursement?
So can you take both home office deductions and the Augusta rule? Great question. In fact, you cannot. So whenever you factor in your $2,000 a day or $500 a day, as I used here, this cannot include home office space. So if your home office is being deducted on an accountable plan inside of your S Corp, you would have to make sure that you exclude that space. You can't double dip. Good question. All right, great questions. I don't know why that got cut off. All right, cool. Well, guys, we've been going about 30 minutes. Huh?
Another question on
Go ahead.
Can you use the Augusta rule on your primary house that you run your business out of?
No. In fact, if your business does not have another office, you couldn't do it. So another way to think about it is, unless Well, you could. Better way to step back is the space that your home office resides in cannot also be it. Typically, what you want to do is have another office space. So what my clients will do is they'll rent like a space at a WeWork or is it Invictus or something, and they have like $250 a month to rent the space, and that's their primary office, and then they have a home office. That's usually what you could do. So it would be an expense that you would incur, but you may reap benefits, right? So you would have $28,000. Let's say for an example, I'm saving $10,300 in this example. If I were to go and rent out, let's call it a WeWork space times 12, right? That is going to be $3,000. So I'm going to spend $3,000 to have a office space use, but I'm saving $10,000, so I net $7,000 in this scenario. Good question.
There's another good question on YouTube. If we have 3 different businesses, can we use 14 days for each business or 14 days for all 3 businesses?
It's 14 days per business. But that's a lot of days, by the way. Be careful. that's a whole month and a half, so you got to be careful. Cool.
I have another question.
Yeah.
It says, I was told that it was ruined by related party rules that only allows a deduction when the other party recognizes income. How do you get around that?
Say that one more time.
It says, I've heard of this, but was told that it was ruined by related party rules that only allow a deduction when the other party recognizes income. How do you get around that?
Not quite sure what you're asking. If you ask it in a different way in the chat, I'll answer it in a future meeting. Not quite sure what we're speaking directly to. However, I'm pretty confident I can answer that. So, guys, we've been going about 30 minutes every Wednesday at 12 p.m. CST. We're going to go live. We're going to answer your questions. We're going to have a topic to discuss. I hope that you're getting something out of this. If you feel like this is something that you could benefit from, please continue to subscribe and follow and do whatever the action is to make sure you keep on getting this information. I'm giving it away completely free, no call to action, just letting you know that there's information out there from somebody who knows what they're doing to help you keep and grow your money. So every Wednesday, 12 p.m. CST, you can find me here. Thank you guys for another week.